In this video, we'll explain how to invest in the stock market for beginners in 2023. If there's one thing we learned from 2022 was that the market can be volatile and the ones who were the least educated got burned the worst. So first lesson, don't be uneducated. But just because 2022 was a down year, don't let that deter you. There has always been down years throughout the history of the stock market. But the overall long-term direction is always up. The stock market, along with real estate, has been the two best places to invest money. When you look at what has performed in the past, the question is how. How do you go about investing as a complete beginner? Where do you start? What areas do you look? What tactics can you implement? What investments do I make? And what stocks do I choose? These are the types of questions we're going to answer in the video. Also feel free to click between timestamps if you don't feel that a particular section is relevant to you. Well, let's say you know a section already, but let's start from the beginning. To know why it's important to invest in stocks, you first need to understand what a stock is. A stock is a business. So when a business wants to raise money, they sell their business to the public on the stock market. This business gets divided into thousands or sometimes millions of equal portions. Each one of these portions is what's known as a share or a section of the stock of the business. So when you own one stock of, let's say, Apple, you actually directly own one small portion of Apple with a business. You are now a business owner. Now I've got a question for you all. What is the purpose of a business? Is it to serve the customers? Yes. To make a useful product? Yes. To make a positive difference in the world? Yes. To be honest here, the bottom line, the true purpose of business is to make money. That's a fact. The great thing about this fact is that when you buy the stock and become a business owner, that business is now designed to make you money because you own it. And that is the reason to get into investing, because you can buy stocks, businesses, throughout the world which have the sole goal of making you money. Even better, this money is passive. You are not working 9 or 5 to earn it. You are not putting on that suit and tie or Iver's jacket, laboring away to make that money. You can just sit, drink coffee, watch Leonardo Matti, the GOAT, play football or go surfing on the beach, whatever your hobbies are. Investing in stocks is passive, not active income. As Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. If that doesn't wake you up and give you some desire to learn investing, or then maybe you should just work until you die. So how do we get started with investing in stocks? Let me show you the key steps to go through. And just to begin with, I want to say you don't have to be a millionaire to start investing in stocks. Investing is available to the everyday person. You can buy a stock in Disney for $90, Coca-Cola for $60, Apple for $140. The stock market is basically affordable to everyone. So in order to buy a stock, you need to sign up to a brokerage company. A brokerage company is a platform that allows you to buy and sell stocks. Now don't worry, this isn't $90.95. You don't need a dodgy broker from Wall Street to do your trades. Go with a well-established company with a proven track record. If you're looking for a very cheap broker, and you're just beginning your investing journey, Robinhood and Webull are quite popular, and you can buy and sell stocks for free with them. Or if you have a bit more money and you're looking for a platform that's been around for a lot longer, look into one like 12 Schwab or Fidelity or TD Ameritrade. They're pretty easy and straightforward to sign up to if you're living in the USA. Just Google them, go to their website, and fill out a form or two. And step 1, find a stockbroker. Done. Once you have a stockbroker, you want to familiarize yourself with a couple of terms before buying a stock. 3 key terms to come to terms with. 1 is a ticker symbol. A ticker symbol for a stock is kind of like a stock's nickname. It's an easy way to find the stock you're looking for. For example, Amazon's ticker symbol is AMZN, Microsoft's is MSFT, Disney's is DIS. Once you've clicked on the stock you potentially want to buy, there are 2 key buy orders you can implement. 1 is a market order. This is when you place an order to buy or sell a stock at the market's current best available price. A market order generally ensures that you will buy the stock, but it does not guarantee a specified price. 2nd, you've got the limit order. A limit order is an order to buy or sell a stock with a restriction on the maximum price to be paid. If the order is filled, it will only be at the specified limit price or lower than that price. That's why I personally like limit orders, but it's up to you. Once you have signed up for a stockbroker, you are now capable of buying and selling stocks and forming a portfolio. But now you need a strategy. If you play a game of football, you have a strategy. If you are in a chess match, you have a strategy. If you're buying stocks in the stock market, it's even more important to have a strategy. So you need to choose how you're going to play the investing game. There are 5 broad types of investing strategies that you can engage in. Let me start off with my favorite type of investing, which is value investing. You ever heard of the names Warren Buffett or Charlie Munger? This is the investing style that they use. The fundamental idea with value investing is to buy stocks that are undervalued where the value of the stock is greater than the price you pay. For example, when you go shopping, you like to find clothes or phone or items that are on sale. You want to find a good deal, a cheap price for a good quality item. Value investing is like shopping for deals, but instead of shopping for a new laptop or a new phone, you shop for stocks. There are essentially 4 key steps to value investing. First, is you look to understand the business that you invest in. You wouldn't buy a business in your local town before you fully understood the business. Its internal components, how it worked, its product, how it makes money, the management. Who's running it? The same idea goes with a stock. So stick to businesses that you are capable of understanding. This is different for each investor. Some investors will understand gaming stocks more than others because they game themselves. Some investors will understand consumer stocks like Walmart or Home Depot because they shop there often and know which stores are better. Every person has a different set of expertise and group of stocks that they can understand. Once a value investor understands the business, secondly they look for ones that have a competitive advantage. What I mean by this is they look for businesses that are not easy to replicate, they have things about the business that helps them beat their competitors. Whether it's Coca-Cola's advantage in that everyone knows Coke and loves it around the world, or Canadian National Railway's advantage in their infrastructure setup and railway lines. Place. Another railway line would struggle to compete because they would have to build a whole new railway across Canada just to start competing. Third, a value investor wants management with integrity and talent. Others are the ones running your business and controlling the day-to-day environment. If your manager is rotten, this will leak through to the employees and the business itself. Lastly, value investors pay a price that makes sense. One where the long-term value of the stock is better than its price. You wouldn't pay $100,000 for an iPhone, even though it is a good product, but you may pay $1,000. You would love to pay $100. When it goes with a stock, you wouldn't pay a ridiculous price for a quality stock. But you would pay a fair price or a cheap price. Some examples of value stocks include Warren Buffett's investing firm Berkshire Hathaway, Micron the chip company, Alibaba the Chinese e-commerce stock, Meta, Suratage Growth, Occidental Petroleum. Dive deeper into these stocks if you like the idea of value investing. And if it makes sense to you. If it in investing is another way you can play the investing game, if you are a fan of consistent income, you don't want to wait for stocks price to go up, you just want consistent cash flow, then consider the strategy. Essentially, when a business/stock makes money, they have 2 key options on what to do with it. One is they can reinvest that money back into the business and look to grow it. The second option is to pay out those earnings to the owners of the stock. This is called a dividend. Normally, dividends are paid out quarterly, but you can also find ones that are paid monthly. A big thing to watch out for though with dividends is consistency. Some stocks will always pay their dividend, some stocks or a session will come, their business will get hurt and they cut their dividends, they're inconsistent. One way you can mitigate a potential dividend cut is by buying what's called dividend aristocrats or dividend kings. Dividend aristocrats are stocks that have consistently increased their dividend each year for 25 years or more. These include IBM, Exxon, Chevron and General Dynamics. Dividend kings are stocks that have consistently increased their dividend each year for 50 years or more. These include Coca-Cola, Colgate, J&J, P&G and a range of other quite mature companies. These stocks, as history shows, are very unlikely to cut their dividends in a recession or in tough times. They haven't done so for 50 years. Some good dividend investors to follow are Dividend Sensei on Seeking Alpha or PPCNN. J.J. Buckner on YouTube. If you're lazy or not even just lazy, you just don't have the time to go about researching stocks, then you may want to consider passive investing. A lot of beginners think passive investing will not get you good returns, but this is untrue. Passive investing in index funds actually beats 83 to 95% of active money managers. So let me quickly explain what passive investing is. Passive investing is when you buy large groups of stocks called index funds or ETFs. Instead of actively picking out individual stocks, you can buy a whole group of them. For example, you can buy the S&P 500, which is 500 very large USA companies. Or you can buy technology index funds if you think that sector will do well. Or you can buy emerging market ones or energy ones, or depending on the sector that you like. ETFs and index funds are a really good way to diversify your portfolio and spread your risk. In fact, this might interest you. Warren Buffett recommends that most investors adopt passive investing in index funds instead of other strategies. I am happy to tell people the same thing I've told them before, but